Hey everybody, Marty Mazzora here. Friday the 31st of May, 2024 with your weekly economic update. Gonna roll through this one this week with just a few inputs to our index. Want to talk about some earnings call commentary, and then we want to look at equities, yields, the dollar and gold as we have been in the past quite a few number of weeks. Starting with our index, we actually dropped 4 points today to a negative 30. A lot of that came from weakening in the commodity space, and I'll show you those charts here in a minute. And economic surprise index actually added to the upside to our index, and I'll talk about that as well. What everybody was waiting for this week came out today, and that was PCE, personal consumption expenditures. Data captures income, consumer spending, and then the inflation data. We can skip the inflation data, came in pretty much right on the mark, kind of sticky at levels somewhat higher than the Fed's target. So there was nothing there that moved the market. The market actually did rally early on. This data came out an hour before the market opened. And that, I think, was on the personal income and personal consumption. Remember, bad news only for now remains good news for stocks. The chart in front of you, the top is the monthly change, and the second or the bottom chart is the year-over-year change in personal income. So as you can see, just a little trend lower here last few months on a monthly basis in terms of personal income. Consumption expenditures were off as well, and again, believe it or not, well, this is the sort of thing we're concerned about because we think ultimately it leads to one of these red areas, which are recession, which would be very bad news for stocks based on where they're priced today relative to corporate earnings. For now, what the market's focused on is inflation and the prospects for the Fed to cut interest rates. That's viewed bullish until or if we move into a recessionary scenario. That becomes very ugly, I think, for a while for equity markets in the US in particular. As for consumer confidence, I showed you it's been rolling over of late. We did get a slight uptick in the Conference Board's consumer confidence number. Wasn't really great under the surface. You can see the level isn't super high. It's kind of in the middle of the range, isn't super bad either. But when you look at the details, it's up, as you can see here, to 102, and that was from 97.5. So again, there's that uptick. But it was 103 in March, it was 105 in February, it was 111 in January. So the trend, as you can see here, has been lower. The present situation and expectation components, they both rebounded from the April drop, with the latter doing a bit better than the former. Inflation expectations, however, actually jumped to 5.4% from 5.3%, and that's now a 5-month high. So that's not good news relative to what the Fed would like to do or what markets would like the Fed to do. With regard to the labor market, kind of mixed, both good and bad in terms of their responses. Spending intentions, about the same, they were mixed. Bottom line, and this is from the report, the overall confidence gauge remained within the relatively narrow range it has been hovering in for more than 2 years, but the survey also revealed a possible resurgence in recession concerns, believe it or not. The perceived likelihood of a U.S. recession over the next 12 months rose again in May, with more consumers believing recession is somewhat likely or very likely. And that is very interesting relative to the narrative that comes from, say, the leisure space still. So I mentioned commodities. Remember, we were flagging this 2 weeks ago. I said that commodities looked very overbought to me. The technicals look suspect. Here's a shorter term chart than we normally look at the Bloomberg Commodity Index. You can see that has rolled over a bit here of late. And since last week, the MACD is actually now flashing a sell signal. Folks, again, we are bulls on commodities, long-term, industrial metals in particular. Near-term, we have the same concerns that I just talked about that are showing up amongst the consumer in that Conference Board survey about recession. Copper, remember we were looking at this up here. I said this was massive short covering, and if that was right, we would see this. We saw that last week. We've seen more of this this week so far. So our commodity indicator, as it reflects economic conditions, those components, and there are three of them in our index, all went from positive to neutral, which was the biggest reason that we saw a decline in our overall index score this week. Now, despite our index taking another step down, the U.S. Economic Surprise Index, obviously different inputs here, and again, this measures actual data as it comes out relative to economists' expectations. That's been moving higher, folks. And remember, I keep saying that good news right now is bad news for the equity markets. Again, take a look at that blip higher in the Economic Surprise Index for the US, and that corresponds with this week's blip lower in the in this chart, the S&P 500 index. So remember, last week I showed you the very big bearish engulfing candle and talked about how bearish that is near a top, and you can see what's happened since. Market is rebounding off of the lows today, still down, the S&P is, but quite a ways off of the low, which occurred virtually right at that 50-day moving average. Makes nothing but sense that the market, even if we're now beginning to correct even more so, along the way, that is short-term substantial support. You can see it was notable resistance here, then it was support, it was both. So lots of commitments made along that line. It would make sense that you'd get a bounce off of that. You break below that, and you break below the 50-day moving average. Wow, there is some potential for hesitation in there. I would say that 5,000 area would be where a swing trader might really want to engage. I don't know that I would right up here. You could, and it may very well bounce right back next week, may be strong. But looking at things like the momentum, for example, have these big concerning long bearish divergences, which makes this market heavy, as I said to you last week. But here you are rolling over, you had a bearish divergence right there, and there you have your sell signal on the MACD. So we'll see. But bulls should be emboldened. You can see there was some buying. They were just waiting for that hit of the 50-day moving average to rush in and buy a little bit today. Where I think we should have more, perhaps longer term concerns would be on the longer term charts. So here's a look at the weekly chart, 10-year weekly. So each bar is a week. And folks, you can see we have a rising wedge pattern. That's bearish. We have a marginal new high, but we have quite the bearish divergences here in momentum and a sell signal. So this is meaningful to me on a broader, longer term look. So this is not a good look. You can see last time we had that was right up here going into the 2022 bear market, which I think peak to trough shaved off about close to 30% on the S&P, 35 to 40% on the NASDAQ. And then notice though, we were actually flagging in here a bullish divergence, and that was leading right up to October. Remember, we got bullish in here, at least in our short-term view. And we had a falling wedge, right, which is the opposite, that's bullish. And we had bullish divergences. Well, now we have a rising wedge and we have bearish divergences. So something to keep an eye on though, but keep in mind what I keep saying though, is that if the data is going to weaken second half of the year, which I expect initially, that's probably going to be still good for a continuation of this current rally in stocks. But of course, that remains to be seen. The technicals are not all that supportive of that narrative. And here is the NASDAQ 100 ETF. You can see it also had a bearish engulfing candle that captured pretty much just the previous day, but that is a bearish looking candle right there at a top. And you can see what's going on in the NASDAQ is still down over 1% today. And it's below that short-term 20-day moving average that we've been talking about now for months and months and months. And so a break below there, you can see test of the 50-day moving average. But, I'm looking at lower lows if indeed something does break and we can capture some momentum. And we now, as of today, have a sell signal on the MACD coming off of overbought territory on the RSI. And by the way, I won't go there, but a similar looking weekly chart for the NASDAQ. Yields, remember I said it's kind of an ambiguous looking chart, but again, here are stocks going down, here are yields going up. We'll see how this plays out going forward. In terms of the dollar, catching some steam right in here, and the NASDAQ was actually catching quite the decline. Today, you've got the dollar giving away a little bit here later in the session, and stocks have actually come back. So there is still quite the negative correlation between the dollar, between yields, and between stocks. And that won't last forever, but that's the way it is right now. Remember, I flagged gold last time. We had our concerns up in here. Gold fell off. It's down a bit today as well, testing its 50-day moving average. We're not going to lose any sleep over a correction in gold. It's come to very lofty levels, all-time highs, in fact. Some corrective action in here makes some sense. What you would say here is that you had a steep sell-off. You're consolidating those right here, and you're breaking down below that right now. So the data is really going to determine what gold does. I think if it weakens, gold's going to correlate pretty nicely with stocks and go up. As it continues to weaken and we get into a recession scenario, which is our base case, actually gold should continue to do well in that environment and decouple from stocks. So it would make sense that we get those two moving in different directions. Of course, folks, all this remains to be seen, just kind of thinking out loud about what can occur in the intermediate term. Okay, so that's it for my charts. Here, once again, with the help of our wonderful resource, Peter Bookfar, and the work he does, let me just quickly paraphrase for you some commentary from companies here this week. And I'll start with the positive commentary. From Costco. As inflation has leveled off, our members are returning to purchasing more discretionary items, and growth in the category was led by toys, tires, lawn and garden, and health and beauty aids. So now they're beginning to see people come back to what they call discretionary items as inflation has leveled off a bit. Dollar General, they reported a 2.4% quarterly comp gain, and, quote, was driven by strong growth in consumer traffic of more than 4% and was partially offset by a decline in average transaction amount, primarily driven by fewer items in the basket. So more people walked in, but on average, they bought fewer things. Dick's Sporting Goods, their 5.3% comp gain was driven by growth in transactions and an average ticket, and they continue to take market share. They mentioned strength across footwear, athletic apparel, and hardline. As a result of our strong Q1 performance, our expectations for continued robust demand from athletes and the confidence we have in our business, we are raising our full year outlook. So real bullish sounding stuff from Dick's Sporting Goods. Chewy, while it is premature to declare an industry turnaround, we maintain our perspective that the pet industry is on track for normalization. Abercrombie entered the year in a clean inventory position and maintained that discipline through Q1, allowing for fewer promotions, which contributed to gross profit rate improvement. One more box. We are starting to see some degree of stabilization. Again, that's different from any kind of inflection point that's sort of looking like we're out of the woods on the macro front, but sort of the lack of increase of headwinds, I think, has been notable in the past couple of quarters, yada, yada. So in terms of negatives on the corporate front, Marble Technology, as for their two main markets, networking and carrier, quote, reflecting a period of inventory correction and soft industry demand, revenue from both end markets declined in the first quarter. From Okta, the macro environment during Q1 was relatively consistent with what we experienced over the past few quarters. In short, it's stable, but still challenging, and most notably having an impact on our mix of new business versus upsell with existing customers. Salesforce was a mess in terms of its stock here this week. We continued to see the measured buying behavior similar to what we experienced over the past 2 years, and with the exception of Q4, where we saw stronger bookings. The momentum we saw in Q4 moderated in Q1, and we saw elongated deal cycles, deal compression, and high levels of budget scrutiny. Makes a lot of sense to me. From Best Buy, the mix of macro factors continued to create a challenging sales environment for our category during the quarter, and our sales were slightly softer than our expectations. From Nordstrom, they said comps were positive each month during Q1, and quarter to date, our positive trends continued, but they are soft. They have softened a bit. Now, Dollar General, they said something positive. Here's what they said that wasn't so positive. We believe the softness in sales in the discretionary category during Q1 is a reflection of the continued pressure our core customers feel on their spending. very value oriented in their shopping behavior, which we see manifested in accelerated share growth in private brand sales, as well as increased engagements with items below the $1 price target. Ulta Beauty talked about the dynamic macro environment, and while we believe our efforts will deliver results, we think it is prudent to expect many of the pressures we identified and faced throughout the first quarter may continue for the balance of the year, and therefore we have revised our annual guidance. Foot Locker, it's important to note that our guidance assumes ongoing challenges with the consumer and macro backdrop. Kohl's, our first quarter results did not meet our expectations and are not reflective of the direction we are heading with our initiatives. Lower clearance sales versus last year represented a more than 600 basis points drag on comparable sales. So folks, I will simply stop there. Wanted to keep this one quick. I went a little longer than I planned, but I think those earnings commentaries are always interesting. They are, anecdotal evidence that I think is very important. Just this week, talking to clients that own businesses in two very different industries. One paints a picture that's pretty bleak. The other one, tied to travel and leisure, says things still look pretty good, but at the margin, they're beginning to see some weakness in some areas that they hadn't seen over the last year or two. But all in all, still a very positive report versus this one that said, things are not good for the consumer out there. So lots and lots of mixed messages. Clearly, the lower end consumer in terms of income is really feeling the pinch. We're seeing that in credit data. Folks who have money and have assets are still out there spending pretty strongly. Ultimately, there are some underlying trends that we think are leading trends that have us somewhat concerned as I continue to report to you here. Folks, hope you have a wonderful weekend, and I'll be back later next week. Take care. Bye-bye.